Welcome back to the Deep Dive. Today we've got a powerful stack of sources, articles, research papers, institutional analyses, and our mission is, well, it's pretty clear. To cut through all the noise and identify the top 5 cryptocurrencies that are actually building the global financial infrastructure for 2026. Because let's just talk about 2025 for a second. It was a year of inflection, but not in the way people thought it would be. It wasn't about Bitcoin hitting some magic number.
Well, not at all.
It was about traditional finance, the conservative players, finally treating digital assets as a core infrastructural layer. I mean, we saw the CME launching Solana futures. We saw JP Morgan start integrating Bitcoin as collateral.
And Ripple got that partial regulatory clarity.
Exactly.
And that institutional adoption, that's really what defines our deep dive today. We're looking past the cycles driven by, retail speculation and focusing entirely on fundamental value.
So 2026 is where it gets real.
It's the year the line between crypto native and traditional finance finally blurs. So we've developed a framework for you. As we go through these 5 projects, you should be asking yourself 3 questions.
Okay.
What's the hard data? Where is the evidence of institutional assimilation? And does the tech actually solve a real-world problem? By the end, you shouldn't just know the names, but really understand why these systems matter.
Right. Let's unpack this infrastructure playbook. And we have to start at the bottom, right? The foundation.
The layer of digital trust itself.
First up, Bitcoin. BTC. We're talking about Bitcoin as, a fun investment. We're looking at it as a protocol of scarce digital ownership. Now, here's something surprising from the sources. Bitcoin actually closed 2025 with a slight annual decline, about 6%. Most people would look at that and call it a failure, but our sources are arguing that this was actually a healthy sign.
It's healthy because it purged the irrational expectations. It shook out the tourist investors who expected a 5x return every single year. And that leaves behind the serious long-term institutional players. And what those institutions are doing, it's not just adoption, it's assimilation.
Wait, okay. Assimilation versus adoption. What's the critical difference there for you?
Well, adoption is just buying the asset. Assimilation is integrating it into your core business model. So when JP Morgan says they're planning to accept Bitcoin and Ether as collateral for institutional loans, that is structural integration.
It's part of the plumbing.
Exactly. Morgan Stanley, PNC, Citi, they're all developing custody and trading products. BTC is becoming part of the plumbing, not just a little side bet.
So this assimilation is what's driving those often cited 2026 value projections, which, they range from $100,000 up to $200,000. What exactly pushes the price from that floor to that ceiling?
It comes down to 3 structural drivers. The first is corporate treasury flows, where companies start treating Bitcoin as, let's call it, programmable cash.
An independent reserve asset.
Right. An efficient way to hold reserves outside of any single national currency. Second, there's stablecoin demand. As this whole world grows, every major stablecoin issuer needs a non-correlated, untouchable reserve asset. Bitcoin fills that role perfectly.
And the third.
And finally, the structural scarcity from the 2024 halving is now fully baked into the supply schedule. The squeeze is real.
The sources call Bitcoin the water in an arid planet, which is a perfect analogy. Because water is vital, but it's not fast.
Not at all.
We're talking about 7 transactions per second, maybe an hour for final confirmation. In a world demanding instant settlement, why would institutions prioritize this slow, kind of clunky protocol?
They prioritize it because of immutability and decentralization. Its value isn't in speed, it's in the unchangeable nature of the ledger. The Cambridge Center for Alternative Finance numbers, they confirm it's slow, yes. But that slowness is a feature of its security model. It is the fundamental layer 0 of digital trust.
And you don't mess with the foundation.
You don't compromise the foundation just for a bit of speed.
Speaking of speed and complexity, let's move to Ethereum, ETH. If Bitcoin is the secure vault, Ethereum is the entire city built around it. One source called it the decentralized conglomerate.
I like that.
It's Manhattan Digital, right? An ecosystem where smart contracts are just generating massive value.
That's right. And the critical catalyst driving Ethereum in 2026 is the tokenization of real-world assets, RWA.
This is the big one.
This is the big one. We are talking about potentially hundreds of trillions of dollars in real estate, corporate bonds, equities, all being represented on-chain. And Ethereum is the leading infrastructure to manage that complexity.
And the numbers back that up.
Oh, overwhelmingly. Ethereum still maintains 58% of the total value locked the TVL and DeFi. That makes it the most liquid ecosystem. And crucially, it hosts 70% of the global supply of stablecoins.
Which is the fuel.
It's the foundational fuel for institutional activity. When Wall Street runs a test, when they prototype JPM coin, they build it on the EVM, the Ethereum virtual machine.
So Ethereum is the system electric of a city. All the important buildings are already wired for its voltage. That's a powerful position. But we still have to talk about the layer 1 speed. I mean, 15 transactions per second is still unacceptable for a global financial layer, isn't it?
It would be if that were the whole story, but 2026 is the year of modularization. See, Ethereum is now focused on being the secure settlement layer. The execution happens somewhere else.
On layer 2s.
Exactly. This is where layer 2 solutions like Arbitrum and Optimism come in. They use roll-up technology to bundle transactions securely, and they are already processing more transactions per second than Visa on a good day.
So the ecosystem solved its speed problem by building out, not in.
Precisely.
Okay, that brings us from the foundation to specialized performance. If Ethereum is the reliable infrastructure of Manhattan, our next project, Solana, SOL, is Dubai, built for sheer speed and scale.
Solana is designed to just push the limits of throughput. But the reason it's on this list isn't just the speed, it's the institutional validation.
Right, the CME again.
The Chicago Mercantile Exchange launching SOL futures and options in 2025 was a huge signal. It means institutions need regulated ways to gain exposure and, critically, to hedge against the volatility of that high-performance ecosystem.
And the performance is, I mean, it's staggering. 65,000 theoretical transactions per second, finality in 400 milliseconds. It holds 30% of daily NFT volume with basically zero commissions.
Oh.
The sources are calling it the broadband internet in 1999.
It really feels like an undeniable upgrade, and it also has major corporate partnerships with names like AWS and Deloitte, but
Yeah.
we have to inject some friction here.
Yes, we do.
Because this speed comes with a huge asterisk.
I agree. We can't ignore the reliability issue. 8 total network interruptions since 2021. That is a catastrophic failure rate for any financial system. For a bank, that's immediate termination. Why are institutions willing to look past that?
That's the core question for 2026, isn't it? The sources suggest they're taking a calculated risk because the upside of that speed is just too great to ignore.
But that risk has to be conditional. Is FireDancer, the new validator client, a guaranteed fix?
It has to be. FireDancer is essential because it aims to reduce centralization and increase resilience. But you hit the nail on the head. Solana's decentralization is still highly questionable. Fewer than 2,000 validators compared to Ethereum's million plus. If FireDancer doesn't deliver stability, that institutional appetite will dry up instantly.
A crucial risk. Okay, so Solana is speed, but speed without compliance means nothing to a bank. Let's pivot now to the ultimate bridge builder, a project whose whole future depends on regulatory acceptance. XRP, Ripple. That breakthrough in 2025, the partial regulatory clarity after years of fighting the SEC, that's what unlocked its potential, right?
Uncertainty is kryptonite for institutional capital. It just is. But partial clarity, that's a green light. XRP's core use case is cross-border payments, where it aims to cut costs from, say, 7% down to a fraction of a percent.
And the key is the legal integration.
That's it. The conditional OCC approval for national digital trust banks that use Ripple is positioning XRP as a legally compliant bridge between the old world and the new.
And how do they actually get that cost reduction? We see references to ODL, on-demand liquidity. What is that, and why does a bank care?
ODL is the engine. It uses the XRP token as a real-time, transparent intermediary asset. So instead of a bank locking up capital in foreign accounts for days...
The old Nostro Vostro system.
Exactly. They just use XRP for a few seconds to bridge the transfer instantly. That efficiency is quantifiable. Banks using ODL are reporting a 40% reduction in operational costs.
Wow.
The speed is there, 1,500 TPS, 3 to 5 second finality. And a 2025 paper from the BIS, the Bank for International Settlements, highlighted the real value. Systems like Ripple reduce counterparty risk by 90%. That's a staggering game.
It sounds like XRP is a certificate of good conduct, opening doors that were locked before.
But doesn't it face the same centralization critique? If it's for regulated banks, how decentralized is it really? That's a fair challenge. The network is fundamentally optimized for institutional efficiency and security, which, yes, often means sacrificing maximum decentralization. The governance is very closely tied to Ripple Labs and its partners, but for traditional finance, that controlled environment is actually a feature, not a bug.
A walled garden they can trust.
Okay.
Now, we have to talk about the connector. Our fifth project, Chainlink, L-I-N-K. The problem it solves is almost philosophical, right? Smart contracts are deaf and blind.
Deaf and blind. They exist only on-chain and can't access verified data from the outside world. Chainlink is the decentralized Oracle solution that fixes that.
But it's evolving beyond that now.
What's fascinating is that Chainlink is no longer just feeding data in. It's becoming the infrastructure for connectivity through its CCIP, the Cross-Chain Interoperability Protocol.
Okay, another big technical acronym, CCIP. Let's make sure everyone understands the institutional relevance of that. What does a bank use CCIP for?
Think of CCIP as the digital customs house, or the universal translator of finance. It lets banks securely move data and value between their private permission blockchains like JPM Coin and public blockchains like Ethereum.
Bridging the silos.
Exactly.
Yeah.
Banks hate friction, but they love security. CCIP provides both the mechanism and the verified security to bridge those two worlds.
So this ties perfectly back to RWA tokenization. Chainlink is providing the real-time, tamper-proof pricing data for all those tokenized assets.
It is the standard for RWA pricing, and what's more, it's heavily involved in central bank digital currency pilots, connecting these new digital currencies to the legacy financial systems. It truly is the translators of the UN. Without this layer, that multi-trillion-dollar tokenized ecosystem just can't function.
But the sources also flag a pretty significant risk here. This project is highly dependent on the success of institutional DeFi. If the banks don't move beyond pilots into full-scale deployment, LNK could suffer. Are there any signs the banks are getting cold feet?
The signs are mixed, but the trend is positive. The banks aren't rushing deployment, they're running extensive due diligence. But the cost savings of RWA tokenization are just too compelling to ignore long-term. The risk is less that they walk away, and more that the transition takes, say, 5 years instead of 2.
Got it.
So, now that we've looked at the 5 players, the foundation, the speed layer, the compliant bridge, and the connector, let's synthesize the patterns you should be seeing.
Lay it out for us.
We identified 4 clear trends for 2026. First, institutional adoption, driven by players like JP Morgan and Morgan Stanley, now overwhelmingly outweighs retail hype. Second, RWA tokenization is the singular defining catalyst for the growth of Ethereum, Chainlink, and XRP.
That's a big one.
Third, regulatory clarity, as we saw with XRP, is the fastest way to inject massive capital into a project. And fourth, Bitcoin remains the systemic anchor. Its function as a corporate reserve asset is only growing while the rest of the market orbits around its stability.
We've seen the infrastructure. Now, looking at the consensus analysis in our sources, what are the price expectations telling us about what the market expects this infrastructure shift to deliver?
Well, these projections are all based on that successful transition from experiment to critical infrastructure.
Okay, so BTC is projected between $100,000 and $200,000. Ethereum, with its RWA dominance, between $4,500 and $6,000. Solana, assuming Firedancer works, is between $200 and $300. XRP, based on its regulatory win, between $3 and $5. And Chainlink, the essential connector, is projected between $25 and $40.
Those numbers are exciting, but as we said, the true value is the foundational shift. However, we absolutely must provide the unfiltered reality. We need to detail the major systemic risks that could just derail all of this.
Absolutely. Let's start with what you mentioned about Ethereum. That SEC status, is it a security or not? That's a huge question hanging over a multi-trillion-dollar ecosystem.
It is the single largest regulatory risk in the space. The SEC's silence on ETH is deafening. If a new ruling designates Ether as a security, the legal headache could halt institutional assimilation instantly.
Then what's next?
Second, we have to revisit concentration and centralization risk. We talked about Solana's 1900 validators and XRP's bank-centric model. The decentralization narrative, the core selling point of crypto, is often much stronger than the reality. You have to look past the marketing.
And finally, the hype bubble issue. The sources were pretty brutal about this.
They were. They state clearly that 95% of the new buzzword projects, specifically calling out anything that's just blockchain plus AI, are basically vaporware. If a project relies only on marketing and not on a real institutional use case, you should be extremely skeptical. Hype collapses. Infrastructure lasts.
Right.
And let's not forget basic market cycles. Bitcoin closed 2025 in the negative. That's a reminder that positive fundamentals don't protect you from daily stress. A major geopolitical shock could override all these positive developments overnight.
So what does this deep dive mean for you? It means action and caution have to go hand in hand. Here is your actionable checklist moving forward.
Okay.
1. Smart diversification. Use the 80-20 rule as a starting point. Keep 80% in the established blue chips BTC and ETH and reserve 20% for that fundamental-backed specialized infrastructure like SOL, XRP, and linking. 2. Technological literacy. Don't invest if you can't explain what an oracle is, what a smart contract is, how a layer 2 roll-up functions. Ignorance is the primary vector of loss in this space.
That's a big one.
3. Volatility preparedness. This is not traditional finance. You mentioned a 50% drop in 24 hours. That's the moment most people panic sell. You have to be emotionally prepared for those swings. And 4. Financial sovereignty.
Yeah.
As ETFs become more convenient, the mantra becomes more important. Not your keys, not your crypto. The convenience is great, but the whole point of this space is direct control over your assets.
And this brings us to our final provocative thought for you to consider as you sort of assimilate this complex picture. When looking toward 2026, the question shouldn't just be about return on investment. It shouldn't be, will 2026 make me rich? The correct, and I think more empowering question is, will it make me free? Financial freedom isn't just about the size of your portfolio. It is about understanding the underlying protocols, the bridges, and the execution layers that govern value transfer globally. That shift in consciousness, that literacy in the new digital infrastructure, that is the true explosion of value we should all be aiming for.